Welcome to Financial Reporting. Today we're starting right at the foundations, understanding how every transaction has two effects, how those effects are organised and how we keep everything in balance. This is where duality, the accounting equation, pearls and T accounts all come together to show you how accounting actually works. And just to solidify your knowledge, we're going to use a little pretend example at the end. By the end of this episode, you will understand the concept of duality in accounting, what pearls is and why it matters, what T accounts are and how they record transactions, and finally, how the accounting equation ties everything together. But before we touch on any accounts, there is one core idea you must understand, and that is duality. Duality means every transaction has two effects, a debit and a credit. Debits or credits are neither good or bad, they are just labels for which side of an account changes, nothing more. Here's a simple everyday example. If I give you £10, well actually two things have happened here. Your bank balance increases by £10 and my bank balance decreases by £10, but everything still balances. That is duality. Nothing in accounting happens in isolation. If a business gains something, it must give up something else or owe something or increase the owner's claim. This idea is the foundation of all financial reporting. To apply this logic consistently, accountants use a simple acronym, PEARLS. So you know which part of a transaction goes on the debit side and which part belongs to the credit side. On the debit side, the P in PEARLS stands for purchases, then expenses, and finally assets. Now that means that any increase on purchases, expenses or assets will go into the debit column. And then we have revenue, liabilities, and shareholders' equity. So any increase in either of those three, revenue, liabilities or shareholders' equity, will increase on the credit side. Again, there's nothing good or bad here. This is just a classification system to make sure that when a debit occurs for say £100, for example, a credit will also occur for exactly the same amount. Okay, so let's have a look at how this works in practice using a T account. A T account is just a visual tool, so you don't have to have a head full of numbers remembering where things are added and deducted from. On the left side of a T account is the debit side. The right side is the credit side. T accounts are used to show the two effects of each transaction clearly, and if you get this bit right and use PEARL's acronym, everything else falls into place easily. Now don't worry if you're getting a little bit lost at the moment with the T accounts, duality, etc, etc. It's far easier to show you with an example. So let's pretend we have a business called Ace Sports, and it's starting off as a market stall selling sporting goods directly to its customers. Okay, in order to use this example, we're going to start with a few simple transactions. On the 1st of January, Derek uses £1,000 of his own money to start his business. On the 2nd of January, he purchases an item for £30 cash in order to sell to a customer. On the 5th of January, he sold that same item for £50 cash. So that's the few basic transactions we're going to start with just to show you exactly how they'd be accounted for. Now, just a very, very important note here, and this is what confuses people in later lessons. Derek and his business are two entirely different entities. That's really important to note that for when we go into future lessons. So if Derek gives £1,000 to the business, he is effectively loaning the business that. That's the way you kind of have to think about it. Derek and his business are two different things. Okay, that's very important to note that. So let's have a look at exactly how these transactions would work. What I've done here is I've set up the basic T accounts that we will be using. That will be the 4 T accounts we'll be using. I'll explain why in a second. They're on the right hand side. You wouldn't normally have this for T accounts, but I've just put debits and credits just as a reminder of exactly what will go there, just so we could clarify what goes where. Okay, so just so it stays fresh in our head, I've put the acronym PEARLS on the right hand side as well, just so you remember when any of those particular parts, purchases, expenses, assets, etc. go up, debits go up, and revenue, liabilities, shareholders' equity goes up, then credits go up. So I've just put that there as a bit of a reminder. And just because it's the first lesson, what I've also done is put the individual items in their sort of class, if you will. So cash is an asset, capital is a form of equity, purchases is an expense and sales is of course a form of revenue. Just to make sure it's a little bit easier just as we get through, because it's most important just to get the fundamentals right before the more complicated transactions start coming into play. Okay, so let's start with the first transaction, which I've just noted down at the bottom there. On the 1st of January, Derek uses £1,000 of his own money to start his market stall. Now remember, of course, Derek and the business are two entirely different entities, so when he's paid £1,000 to Ace Sports, they have that increase of cash of £1,000 on the 1st of January. And because cash is an asset, and when assets increase, they go on the debit side, we pop that in the T account under cash for £1,000. But as you know, there has to be a second transaction to match that. If we've got a £1,000 debit, we need a £1,000 credit as well. So the second part of that transaction is that we put £1,000 on the credit side under equity. Equity is basically just what the business owes the owners. So on one hand, they've increased their cash by 1,000 when they were given that, but of course they also increase what they owe out by 1,000 as well, so it remains in balance. So let's have a look at the second transaction written at the bottom there. On the 2nd of January, Derek purchased an item for £30 cash to sell. So that £30 goes under purchases, which is an expense. And because it's an expense and because it's increased, it goes on the debit side. So on the 2nd of January, we put £30 on the debit side under purchases. But as you know, if it's gone on the debit side somewhere, it has to go on the credit side somewhere else. And that credit transaction will go under cash. Now, if they've used the £1,000 cash in order to pay the purchases, cash has gone down by £30. So purchases have gone up by 30, cash has gone down by 30. So we put it on the credit side of cash, because when an asset is reduced, it goes on the credit side. When it's increased, it goes on the debit side. So on to the third transaction. He sold an item for £50 cash. That's on the 5th of January. So the first part of that equation, so that £50 is obviously a sale, which means it falls under the revenue column, and because revenue has increased by £50, we put it on the credit side according to the Pearls acronym, okay? But the second part of that transaction, you may have guessed, it has to be a debit, and if he sold something for £50 cash, and it's £50 credits going on sales, then the other £50 has to go on a debit side, which is cash. So on the 5th of January, we put a £50 transaction in the T account for cash, which is an asset, and as I said, assets increase, it goes on the debit side. Now, if you have a quick glance down the debit sides, and you probably add them up very quickly in your head there, and they come to £1,080. And if you have a look down the credit sides, they should also come to £1,080. If they don't, something has obviously gone wrong somewhere in the calculations, or the inputs, I should say, of the transactions. Now, it may seem overkill to have this many T accounts just for a few transactions, but you have to try and visualize if there were hundreds of these T accounts, hundreds and thousands of transactions. Okay, modern technology kind of takes a lot of this old-fashioned sort of work away, but it's really important for the purpose of either exams or just for your own understanding that you do understand exactly how T accounts work. And this brings us to our final point, the accounting equation. What exactly is it? Assets equals equity plus liabilities. Or put another way, everything the company owns has to equal everything the company owes. So just as a quick review of the learning outcomes of this video, the concept of duality in accounting is that every transaction has two equal effects. There are no exceptions to this accounting rule. What Pearls is and why it matters. Well, Pearls helps you identify which accounts increase on the debit side and which on the credit side. And there's a list there for you again. Purchases, expenses, assets on the debit side, and revenue, liabilities, and shareholders' equity on the credit side. What T accounts are and how they record transactions. Well, remember, T accounts are just a visual tool that clearly show the two effects of each transaction, just for ease. And of course, finally, how the accounting equation ties everything. Assets equals equity plus liabilities. So in short, everything the company owns equals everything the company owes. If you understand that, you understand the foundations of financial reporting. And that is the logic behind duality, pearls, and T accounts. If this helped, please like and subscribe. In the next episode, we'll keep building on our ACE sports business with more complicated transactions along the way. Thanks for watching.